Profit margin is a financial metric that shows how much of a company's revenue turns into profit after expenses. It is expressed as a percentage and helps businesses measure profitability and efficiency. Types of profit margins. Gross profit margin measures how much profit remains after subtracting the cost of goods sold (COGS). Formula: revenue COGS divided by revenue times 100. Example: a company earns $100,000 in revenue and has $40,000 in COGS. Gross profit margin equals 100,000 to 40,000 divided by 100, 000 times 100 equals 60%. What it tells you: how efficiently a business produces goods and services. Operating profit margin measures profit after deducting operating expenses like rent, wages, and utilities. Formula: operating profit divided by revenue times 100. What it tells you: how well a company controls operational costs. Net profit margin measures the final profit after subtracting all expenses, including taxes and interest. Formula: net income divided by revenue times 100. Example: if a company earns $100,000 in revenue and has $10,000 in net income, the net profit margin is 10%. What it tells you: the company's overall profitability after all costs. Why are profit margins important? Measure financial health. Higher margins indicate strong profitability. Compare companies and industries. Helps investors evaluate companies in the same sector. Identify cost management issues. Low margins may signal high expenses or pricing problems. Improve decision-making. Businesses adjust pricing, cut costs, or improve efficiency to increase profits. Example of profit margins in action. A bakery makes $50,000 in revenue and has $20,000 in ingredient costs, COGS. Gross margin equals 60%. $10,000 in rent and wages, operating margin equals 40%. $5,000 in taxes and interest, net margin equals 30%. This means for every $1 earned, 30 cents is actual profit after all costs. How to improve profit margins. Increase prices. Raising prices without losing customers boosts revenue. Reduce costs. Cutting unnecessary expenses improves margins. Improve efficiency. Streamlining production reduces waste and saves money. Negotiate supplier deals. Lowering material costs can help maintain higher profits. Quick recap. What is profit margin? A measure of how much profit a company makes from revenue. Types: gross margin, after production costs; operating margin, after expenses; net margin, final profit. Why is it important? It shows profitability, cost control, and financial health. How to improve it? Increase prices, reduce costs, and optimize efficiency. Profit margins help businesses understand how efficiently they generate profit, guiding smarter financial decisions and long-term success.